Good evening, everyone. Thank you for joining us tonight for our Market Outlook presentation on navigating complexity. My name is David Sung. I'm the president of Nicola Wealth, and it is my absolute pleasure to welcome all of you tonight and to open our presentation this evening. So, you may have heard in our opening video that Nicola Wealth was founded in the year 1994, which means that this year we celebrate our 30th anniversary. Thank you. So we thought we'd have a little bit of fun with that tonight and travel back to the year 1994. So here's a question for everyone. Aside from the hockey riot here in Vancouver, what do you remember about the year 1994? Perhaps you recall being glued to your televisions, watching a Ford white Bronco speed down the streets of Los Angeles with a lineup of police cars hot in pursuit. For those of you who aren't laughing, it means you're a little younger than the rest of us here tonight, and that is with reference to what some consider to be the most notable media event of 1994, involving a now notorious or infamous ex-professional athlete by the name of O.J. Simpson. Yes. What else do you remember about the year 1994? I decided to put it into Google because we put everything into Google to help jog my memory, and the first thing that I noticed was, of course, Google did not exist in 1994. In the bottom left-hand, I think, of your screen, you may recognize that logo of Netscape Navigator, which was one of the first commercial internet browsers launched in 1994. And in the bottom right of the screen, a gentleman by the name of Jeff Bezos. You may recognize his name. He's currently the world's third richest person. He launched an online bookstore, which we all know is called Amazon. And Prime Minister Brian Mulroney in 1994 signed NAFTA, the North American Free Trade Agreement, which of course has subsequently been renamed by Donald Trump to the US-Mexico Canada Agreement, or the USMCA, which to me kind of sounds like a song from the Village People. Nelson Mandela, he was elected the first black president of South Africa in 1994, and of course right there in the middle, the television show Friends became a global hit sensation, perhaps taking us away from some of life's complexities in the year. And lastly, as we mentioned, Nicola Wealth was founded right here in Vancouver in 1994. We started with 80 million of client assets and 7 staff. Now, let's head back to the future, back to 2024, and it's a privilege to stand in front of you today on the cusp of celebrating our 30th anniversary, 30 years of growth, and an unwavering commitment to our clients' financial well-being. With a little over 15 billion in client wealth, and now with 500 employees spread across the country amongst 8 offices, Nicola Wealth now stands as Canada's 10th largest private investment counsel firm in the country and the 2nd largest private investment counsel firm amongst non-banks. But I would say something that we are probably more proud of than that relates to the Nicola Wealth Private Giving Foundation. You see, giving back and giving to our communities is one of our company's deeply embedded corporate values, which led us many years ago to establish a public foundation, a registered public foundation in Canada, which we call the Private Giving Foundation. And in turn, inside that, it allows us and our clients to establish their own foundation-like accounts called donor-advised funds. Last year, in 2023, from our own company account, all championed by our employees, Nicola Wealth donated close to $3 million to charities here in Vancouver and across the country and some around the world. But our clients, many of you who are here tonight, through your donor-advised funds, through your generosity and philanthropy, our clients dispersed from their donor-advised funds over $29 million to charity. And over the past 3 years, that number has been over $90 million, close to $100 million, which now has made the Private Giving Foundation the 4th largest public foundation in the country amongst financial institutions, and that includes the banks. So Thank you. Thank you. To our clients here this evening, thank you for allowing us over these past 30 years to be a part of yours and your family's financial, philanthropic, and legacy journeys. Thank you. So our theme this evening, navigating complexity, it seems particularly appropriate because quite simply, there's just a whole lot going on in the world right now. Can you guess to yourself how many global elections there's going to be this year? 5? 10, 15, 20? Close. There will be over 50 global elections this year, making 2024 the single biggest global election year in history. And the resulting geopolitical tensions that this will add, it will add layers of unpredictability to market dynamics. And in addition to that, advancing technologies such as artificial intelligence and the resulting social implications of those technologies will add additional layers of unpredictability. Now, navigating these risks and all of this complexity using a pension-like approach is exactly what it is that we do for our clients. We do this for individuals, for families. We do this for foundations, endowments, charities, Indigenous communities, and family offices across the country. And the investment philosophy that we use and the approach that we take aims to substantially reduce and mitigate volatility to the marketplace. It's an approach that is used by some of the world's largest and best performing pension plans. In addition to this, it is based on a solid foundation of publicly traded securities, but we aim to further diversify away from the public markets into areas such as private real estate, high-quality commercial private real estate such as industrial assets and self-storage properties, into other private asset classes, into high-quality private businesses through private equity, into private debt, commercial-grade real estate, and infrastructure assets. Now, it's an approach that we have spent the past 30 years refining through good times and through challenging times over the past 30 years. And we have tracked the performance of our investment approach going back to the turn of the century, in fact, back to January 1st of 2000, right through 3 years of a tech bubble decline, through the great subprime financial crisis of 2008, through the COVID-19 drawdown, right through to today. So over the past 24 years, we have tracked this performance. But before I share what that number has been with you, I think a little context might be helpful. And to do that, we're actually going to zoom in and take a look at short-term performance before we zoom back out and take a look at the long-term result. So what you're looking at on the screen is our 2023 results, and the Nicola Wealth Core Portfolio Composite is represented by the purple bar. And as you can see, we've actually slightly underperformed a 60-40 portfolio model. That 60-40 balanced model references 60% into the public equity markets with 40% into the public fixed income markets. And last year, we slightly underperformed, as you can see by the numbers. But that slight underperformance, by the way, in our view, using a baseball analogy, we still like to call that a good base hit. So now we're going to take one step back and look at 2 years worth of performance. And this is 2022, the year before, which was a very volatile and tough year in the public markets, anywhere from minus 10% all the way to minus 20% in the public markets, and that includes fixed income. That resulted in a 60-40 model being down minus 8.7%, or another solid base hit, up 6.5% for our core model. And so these bar charts, while they might be interesting, a lot of people might just simply say, well, what's the math behind this look like? How does that translate into real-world number results? And so we've put an example together. We've got $1 million invested at the start of 2022. And as you saw by the numbers, a base hit, 6.5% return, minus 8.7 for 60-40, ending the year at $1,065,000 for our core portfolio and $912,000 for a 60-40. We then jump into last year, 2003, another base hit, 5%, underperforming a 60-40 portfolio at 8%. And over a 2-year period, the numbers work out to our core portfolio being up a cumulative 12% and a 60-40 still underwater at minus 1.4. And this is the importance of protecting the downside. Not losing money is a great part of a good investment strategy. So with that context, when we look out over 24 years, starting in the bottom left-hand side of your screen, with $1 million invested, right through 3 years of a tech bubble drawdown, our cumulative result up over 15%, through the subprime crisis of 2008, and over 24 years, that's been our single only negative year, but it wasn't a minus 16% from a 60-40 approach. We've looked at 2022 right through to today. With the cumulative result net of all fees and expenses, many of our clients have experienced a 7.02% compounded rate of return over 24 years. That's 2.5% higher, 2.5% compounded over 24 years. That's the difference between 1 million going to 5 million plus and 1 million going to 2.8 million. This is what we call all-weather investing. Now, while our presentation this evening is about investing, we firmly believe that everything starts with having a solid financial plan. You put a plan in place, you review the plan, you rework the plan in a constant and ongoing cycle. And our wealth advisors who work directly with our clients, they bring their advanced financial planning and their asset allocation skill set to bear in recommending bespoke and custom recommendations for our clients. And it's this combination of advanced planning with all-weather investing that enables us to deliver to our clients an exceptional experience and results. So we recognize that now more than ever, bringing our clients peace of mind and stability and consistency with this ever-changing landscape of complexity is going to be and will continue to be our ongoing commitment to you. So let me set up our presenters for this evening. You will be hearing from our top investment professionals. You'll be hearing from the leaders of our 3 main investment asset class areas of real estate, private capital, and public markets. But before you hear from them, and they will drill down into the details of areas that they have of concern in their area, in their respective areas, and where they see the opportunities. Before you hear from them, first up on the stage is going to be our CEO, John Nicola. He'll be discussing the macroeconomic overview, or as the rest of us like to call it, the big picture. John, welcome to the stage.
Let me just start by saying I want to thank all of you for being here tonight. It was a little sketchy with the weather, and if you're not from Vancouver, you have to understand something, that what we experienced this afternoon is what we call a blizzard, okay? For our friends from Calgary, they might think of it maybe as a good day to have a summer barbecue. But, we're pampered here in the West Coast, so we actually worry about, a half an inch of snow. About a year ago, I wrote a newsletter about trying to look at the big picture from 30,000 feet, not getting, if you will, too close so that you can't see the forest for the trees. And we want to stick with that theme tonight. So there are 5 areas that I'd like to focus on in the time I have up here. The first is one that we used last year, aging, the impact of demographics. If there's one thing that will impact everybody in this room's wealth for as long as they live, is going to be demographics. We'll take a little bit of a look into why that's the case. The last couple of years has not been, as David has pointed out, a great time for most asset classes. So what does that look like as we're going through the beginning of 2024? What's going to happen with inflation and interest rates, where they've come from, but more importantly, where they're likely to go? What's going on with respect to trade and reshoring? And maybe the biggest question mark is what is going on from a geopolitical perspective and how much danger and challenge does that create for building wealth and building a portfolio. So let's start there. So geopolitics. Now, David alluded to the elections that are going on around the world. Obviously, this big one going on in the South. I kept thinking to myself, what I'm seeing when I'm watching all of these rallies and stuff reminded me of this movie from years ago called Dumb and Dumber. Except in this case, it's old and older. And, but I will tell you this. I have decided to get a pair of the new gold sneakers from Donald Trump. And the reason why is because talking to my grandkids, they wanted me to dress up for Halloween. So I thought I really should try, and I couldn't think of anything better than these shoes. We have a serious amount of tension, of course, between China and the US, and I would argue it's getting worse. We have the Ukraine war just entering its third year, which is extraordinary in so many ways, especially considering it was supposed to be over in a week. And unfortunately, politically, again, this is an issue with the US. The US is holding up, the US Congress, I should say specifically the House of Representatives, $60 billion in aid to Ukraine, because essentially they don't want the Congress, and specifically Biden, to get credit for another part of that package, which is dealing with immigration and migrants. And then finally, of course, the tragedy that's going on in Israel and in Gaza. Let me switch gears for a second here, and let's take a look at the issue of interest rates. What you're looking at here is a graph of 10-year bond rates in the U.S. against 3-month Treasury bill rates. And the thing that you want to look at is that line that I've just drawn where it's zero. In other words, at that point, 3-month Treasuries are the same as 10-year bonds. Now, if you think about it, if somebody asks you to lend them money for 10 years as opposed to 3 months, you're going to expect a higher rate of return. And in fact, traditionally in the U.S., the 10-year bond rate has been 1.15% higher than the 3-month rate, which makes sense. But right now, it's 2.25% above where the 10-year bond rate is. This is called an inverted yield, and we've had maybe 8 or 9 of them in the last 50 or 60 years, and every single one of them has led into a recession. So one of the things we have to prepare for that we haven't seen any signs of in the U.S. is a recession, but those things are not the same in other parts of the world. The other thing that's going on are markets. Now, this is a little hard to read this graph, so I'll just read it out. This is the S&P 500 as of Friday, and it is up in the last 12 months 28%. So it's on a tear. But there's more to this picture than meets the eye. If I take a look at the equal weight index, in other words, if I take out the stocks that really drove the S&P 500 last year, that index is up, but it's up 10%. And who are these stocks? This is the Magnificent Seven, primarily tech stocks, Amazon, Apple, Tesla, NVIDIA, and 3 other companies. Now, you can see the gains. The worst result is in Google, around 45% up, and NVIDIA is up, 250%. And NVIDIA is kind of an outlier because because of AI and because of the work that they're doing in chips, they are kind of an outlier. The other ones, not so much. But if I take a look, as David said, he looked at our returns over 2 years. Let's look at these guys over 2 years. So in actual fact, Google is actually minus 2% for the last 24 months. And if we're taking a look, this is Apple up 8%. That's okay, but it's not exactly spectacular. And Tesla's down 30% cumulatively over the last 2 years, notwithstanding a huge increase last year. And then we have to take a look at the S&P 500 overall. Same thing that David was referring to about the performance issues. Huge drop in 2022, big gain in 2023. Net result, the market is up a total of 3% over the last 2 years. And this is one of the hottest stock markets in the world. So let's take a look at another aspect which I worry about. 3 of the largest 6 economies in the world are already in recession, starting with the United Kingdom, Japan, and Germany. And Canada, while not technically in a recession, had negative growth in the last quarter, and by the end of the first quarter of this year, we could easily see another negative GDP figure for the quarter. If we do, will be in a recession. The outlier is the United States. They're just going on fire. They've got a huge, significant increase in their GDP. They've got incredibly low unemployment numbers. It looks like everything is picture perfect in the US from an economic perspective. Let's first, and I'm going to come back to that question in a second because I think there are some other factors in the US that drive this. Now, we said we'd talk about inflation. These are recent inflation numbers. In Canada, it was a bit of a surprise that we dropped below 3%. We see similar numbers in the United States, similar numbers now in Europe. We seem to be stuck a little around this 3% mark. In other words, you can see it's hovered around this mark in the case of Canada for the last 6 or 7 months. But where there's kind of a bright light is this commodity index. This is a Bloomberg commodity index. And in the last 2 years, it has dropped 29%. And this is a major driver of producer price index, and this is a major factor ultimately in where inflation numbers are going to come from. Now, if we want to take a look at someplace that's really suffering, we can look at China. So China not only doesn't have an inflation problem, they have a deflation problem. For the last 5 months, China's consumer price index has been dropping at an accelerating rate. And even worse than that, their producer price index, so this is the index that we use for factory gate pricing, the way goods are priced. And that has been in a deflationary space for more than a year. Now, interestingly, when you think about economics and you think about your investments, paradoxically, deflation is worse for most investment strategies than inflation. So people have been worried about inflation, especially over the last 2 or 3 years, and that may be fair. You don't want it to get excessive, but trust me, the last thing you want is any extended period of deflation. We talked a little bit about aging and demographics. I want to touch on that. So this is a world population projection, and what you can see from the top is roughly, there's been a 6 million person drop in the growth of the world's population in the last 6 years. So the rate of growth of the world's population is shrinking, and this is supported by the UN population graph. If you take the median line, that's the blue line in the middle, that shows that the world's population will probably flatten out at 10 billion people, I should say, roughly around 2080, 2090, something like that, and then start to decline. Now, that may seem reasonable. You know, we have too many people in the world using up all of the resources. That all makes sense. But the problem is it's not just that the population is slowing down, it is aging. And that median age is rising at an incredibly rapid rate. You know, China's median age has gone from 19 to 39 in a period of about 40 years. That is an incredible rate of growth and aging. And the thing about aging is deflationary. So you may start to sense a bit of a theme here I'm on, because I'm concerned more about this than I am about inflation, as I mentioned before. So let's take a look here at the Chinese population specifically. It peaked 2 years ago and has been shrinking since 2022. Last year, it shrank by about 2 million people, which against 1.4 billion may not seem like that much. But its labor force peaked in 2014. And its labor force is down 30 million people from its peak just 10 years ago. And that is a major issue, and it will be a major issue for China going forward. But what's even a bigger shock, this isn't the birth rate in China. This is the actual number of births. And that has dropped by 50% from 18 million to 9 million in a period of less than 8 years, 7 years specifically. So this is a material issue, because this is literally your future generation. So the chances of the labor force in the future rising is pretty close to zero in China. The other issue in China is China has used debt to fuel its economic growth. So the strange part when you look at Chinese statistics is that China, it claims they're struggling with their growth, but they still had a 5.2% GDP growth last year. And so when you look at the nominal numbers, it looks like it's not so bad. But let's look a little deeper into that. This is the growth rate of local government debt, where a lot of the debt is borrowed in China, often through vehicles called local government financing vehicles. And the amount of debt has been growing at 13% a year. It says 33% a year. That's a typo. It's 13% a year for the last, let's say, 10 years. But that's not the real story. The real story is the interest cost on that debt has gone up by a factor of 10. They're paying 10 times as much interest this year that they were about 8 or 9 or 10 years ago. And in many cases, local communities cannot afford to pay that interest because it's more than their entire budget. So what they're doing is they're basically using these off-budget, off-balance sheet vehicles called local government financing vehicle, and getting banks to lend them money in order to prop up and allow them to continue to be able to operate their services. And there's some very strange things going on in China. For instance, local governments make all their money from selling land, and they make none of their money from property taxes. So their model really isn't sustainable in the first place. So the debt to GDP just recently was announced grew to almost 300%. And there's a small thing you can see below that. Last year alone, their debt to GDP, to the amount of debt they borrowed as a percentage of their GDP, grew by almost 14%. So they had to borrow 14% of their GDP to get 5% growth. That is absolutely unsustainable. So basically, this is what's occurred here in China. Debt has doubled since 2008 as a percentage of the overall economy. Now, you've heard about the ghost cities in China, sort of the empty homes. This is a ghost city 130 kilometers south of Beijing called Zhonggang. And Zhonggang is here. You can see where Beijing is. This city has got thousands and thousands and thousands of apartments, stores, schools, roads, infrastructure. It's completely empty. Now, one of the things you have to think about when you're talking about, what is your GDP? This is part of the GDP of China. Somebody built this, it cost money, billions and billions and billions of dollars. This is part of the GDP, but it didn't produce anything because it's empty. And overall, there's about 60 to 80 million homes in China that look like this. So if you have a shrinking population, what's the chance, never mind being able to fill any new homes somebody wants to build, what's the chance of filling the 60 or 80 million homes that are empty now? And keeping on the track with China, because these are all financial statistics, which I think are problematic because I think they drive a lot of the geopolitical issues as well. So what you're looking at here is a little graph of the Chinese stock market. And in the last 2 years, the Chinese stock market, which is not really that large a market, has lost $7 trillion of wealth in a period of 2 years. So now Japan, a much smaller country, has a stock market capitalization that's higher than that of China's. Now, interestingly, speaking of things that take a long time to come back and get a return, Japan just announced that their stock index has finally got to a new peak, a new level it had never achieved before. The last time it got close to this level was 1989. So it only took 35 years for it to get to the point where it was back in 1989. So you can imagine what it feels like to be a Japanese investor in stocks. The Chinese stock market has basically been flat for the last decade. Compare that to the S&P 500 or the MSCI India Index. Again, these are problematic issues. And part of the issue, of course, is China is a communist country, and that is, with a lot of state-owned enterprises, makes it very hard for capital to be free and work properly. And the other thing that happened just recently, this is a graph of imports from China to the from China to other countries, the U.S., and then it also shows imports to the U.S. from Canada and imports from Mexico. Last month, or in the month of December, I should say, at the end of last year, Mexico overtook China as the largest trading partner of the U.S. And a few years before, it overtook Canada. When it overtook Canada, the gap between Canada and Mexico and China was 65%. That's gone now. And now China's trade surplus, or trading with exports to the US, is the same level that Canada is now. One of the other things I worry about, and this is one of the reasons why I think maybe hopefully that interest rates may fall sooner than people think, is the huge amount of pressure, especially in the US, on the Fed, because interest rates have not really materially moved over the last, 9 months. So this is the amount of debt in the US. This is corporate debt that's maturing in the next 12 months, $2 trillion. 24 months, 4.5, 36 months, 7.3 trillion. That debt has not been impacted by these higher interest rates yet. It's about to be. And that's going to have a material impact on the income and the profits of a lot of American corporations. And below is the distressed debt. 20% of commercial and multifamily mortgage balances are also due next year. Even worse, almost a third of all US federal debt is maturing this year and will cause a huge increase in the interest expense. And how big is that increase going to look like? Right now, it's about $800 billion a year of interest that the US pays. It will reach $1 trillion by 2026. In the decade after this one, it'll be $12.6 trillion of interest, not principal, that will have to be paid. That is, even for the US, a very significant part of its federal budget. So, would it make a difference if the Fed made a decision that interest rates might drop sooner than later? Maybe. Now, this is a weird website. I don't know how I found this website. I'm looking for predictions about mortgage rates, and I see this organization called WOW. And I'm saying, what does that mean? And I spent an hour trying to find out what WOW means. I couldn't. If any of you can find out what it means, I'd love you to tell me. But I took their analysis being accurate, so I'm happy with that. What you're looking at are mortgage rates. So they're looking at a variety of mortgage rates, and they're predicting where they might be over the next few years. So they start with the 5-year variable rate currently at 5.9%. They think it'll be down to 3.9% within 2 years, 2.5 years at the most. And so that's a material drop in terms of the interest expense on a mortgage. However, because of the inverted yield curve that we have, you're not going to see the same thing on fixed-term mortgages. So right now, you can get a 5-year fixed-term mortgage for 1% less than a variable mortgage. They expect the most that's going to drop is less than 0.5% over the next 1 to 2 years. So again, how much you save in terms of what happens when interest rates decline depends on the kind of mortgage you're financing as well. So don't expect to see big drops in fixed-term rates. Okay, so we're back to my interesting theory about inflation versus deflation. Okay, so let's examine basically what causes deflation. So these are the factors that matter. And for this, I'm going to need my glasses, okay? So we have global recessions can trigger these things. Fiscal austerity, we're not seeing much of that anywhere in the world. Basically, a lack of confidence, and supply issues. Now, so basically what these do is these reduce demand, and that is deflationary. Now, on the other side, now it says here lower oil prices, but really you could substitute lower commodity prices. Improved technology does make a difference. Technology helps reduce the cost of so many things. And basically the issue of declining import prices. Now, declining import prices may sound strange, but again, coming back again, is a good example. Right now, the EU is taking a hard look at the situation in China on electric vehicles. And the reason they're taking a look at them is because they're selling at a 20% discount to European equivalent electric vehicles because they're subsidized. And so that basically is a deflationary impact on the sale of cars in Europe. So the question really is that likely to happen? We took a look, I want to take a look here at the what David was referring to, the beyond stocks and bonds slide that you saw earlier. We look at things as being the whole is greater than the sum of its parts, what we call strategic asset allocation. But there's another part that matters, which is the tactical asset allocation. We have to execute well in each asset class. We can't just have a really good strategy for allocating between stocks and bonds and real estate and private capital. So the normalized model looks like this: about a third, a third, a third between fixed income, real estate, and equities, private and public. But we changed that model earlier in 2023 to a much larger allocation for fixed income at the expense of real estate and equities. And the reasons were that basically we can get very high fixed income yields in relation to historically what we've been able to get. The equity markets are expensive, and we see this as lower risk. We can get equity-like returns without taking equity-like risk. So if we take a look at fixed income, we have to look at the decision between how much is public versus private, and then should it be high yield versus government debt? Should it be, what kind of duration on the debt should we have? Should it be leveraged? Should it be mortgage versus corporate? What currency should it be in? So all of these are decisions that are done at the tactical level. So does this theory work? Well, this is what you're looking at here, is the returns for the bond index, it's an ETF actually, in Canada over the last 3 years. You can see each year was negative. That's maybe arguably the first time that that's actually occurred. And over the 3 years, if you've been in that index, you would have lost 15.5%. And we're talking about bonds. These are safe bonds as well. How did our fixed income portfolios do? Well, in the bond area, we earned 4.7%, in high yield bonds 12.8, 19.1 in the balanced mortgage fund over 3 years, and 24.7% in private debt. In fact, if you had a quarter of your capital in fixed income in each of these categories, you would have earned 15%, which means then that as of today, you'd be 35% higher in that portfolio of fixed income than you would have been in that bond ETF. So why is that the case? We took a position of having short duration bonds and mortgages and floating rate debt for most of that period of time. We separated credit risks. We looked for higher yields which were available in fixed income in private debt and mortgages as opposed to public debt. And it's ideally suited for registered plans because of the fact that they're taxable otherwise. When we take a look at equities, again, the what else, 70% public and 30% private, but the what else includes Canada versus US versus international, large cap versus small cap, private equity versus venture capital, growth versus value. One of the reasons we like private equity, this is a chart that was put out not too long ago, and it's over a 22-year period to the end of 2022, and it talks about the returns on private equity versus the small cap Russell 2500. The difference in returns over 22 years per year is almost double. So that's why we feel it's an important asset class to be part of our clients' portfolios. When we talk about real estate, 90% of our real estate is private because we feel we can add value there. Only 10% is public. And then we take a look at Canada versus the US, industrial, office, retail, multifamily, residential, specialty, which Mark will speak to. Income versus development, existing versus built to own, and the geography and demography in the area. All of these are factors which impact the likelihood of improving relative rates of return. And the proof of the pudding in this is that you're looking at a comparison between our US real estate fund and the equivalent public fund in the US, which would be the NAREIT index. And if you take a look at the total return over the last 13 years, 14 years, is about a 62% higher total return, and it's done that at 82% less volatility. So it's not just that we want to get a better return, we want to take less risk getting that return if we can. Which brings us to this Dalbar effect. So the Dalbar effect, you can see this is a roller coaster, obviously. And this is what happens with the Dalbar effect. The Dalbar effect says, as markets rise, you're either optimistic, you get excited, you get thrilled, maybe you get euphoria, and then things start to change and you go into denial and anxiety. It's like 12 steps, basically. And you finally get to this point of capitulation, despondency. And of course, people will buy at the peak, emotionally, because everybody's excited, and they will sell at the bottom because they're depressed. Now, people will say, well, that's interesting, but people don't do that. Well, actually, they do. So what Dalbar did is they took a look at 30 years worth of statistics, and they compared the S&P 500 to people who invest in equities in the US. And the gap is almost 3% a year per year over a 30-year period of time, which means the amount of wealth that's accumulated or collected is less than half. This is all about behavioral finance. You can read all about this in books by Daniel Kahneman and Amos Tversky. Basically, the science behind this is very, very solid. So controlling the so-called Dalbar effect is something that's meaningful. Now, one of the things that we try to pride ourselves in is that we take a disciplined approach and we work with clients actively. We sit down with them. We have a strategy about how their investments are going to be developed. If we're good at what we do, the Dalbar effect should be pretty minimal for our clients, which is exactly what happens. So what you're looking at are two things here. We have a fund. It takes into account all of the pools we manage, follows our asset allocation model. So we'll call that the market. And then we have the client results. If the Dalbar effect was affecting our clients, their results should be lower than the fund. But they're not. They're identical. So effectively, there is no Dalbar effect, which means our clients are not losing out on having bad timing impact their outcomes. And that's an important part of the work that we try to do. So just to finish up, how or where can we add value? This brings it back to where we're going this year. So on the real estate side, industrial, residential, we're going to reposition assets. We're looking at special situations like storage, build to own. Will office ever get cheap enough? If you talk to Mark, if he never sees another office building again, he'll be happy. He can explain that to you later. Private assets, mortgages, and private debt are a key issue. Separately managed accounts help reduce expenses. Higher for longer is the theory, and I did have this theory for a long time, but I'm starting to waver on that. My deflationary hairs are coming up. I don't know why I'm talking about hair. I don't have any hair. So, floating rate debt for now and transition to longer duration over the next few years. And then finally, on the equity side, we want to directly manage assets. We want value in a cash flow approach. And when we do private capital, we don't want it locked up in 15-year limited partnerships. We want it to be open-ended and evergreen so people can be in and out of that in reasonable timeframes.
Thank you, John. Informative as always. And thank you for coming this evening. In 1896, if you wanted to make money, you did one thing. You headed north. You went to the Yukon. You went looking for gold. It was the Klondike Gold Rush, and everyone who wanted to make money went there. 100,000 people went to the Yukon in searches of riches. They traveled across difficult terrain in minus 50-degree weather to get rich. The thing is, that's not actually what happened. Only about 3,000 people found gold, and only a few hundred became wealthy. There's a quote I love from Mark Twain: "When everyone is looking for gold, it's time to be in the picks and shovels business." You see, that opportunity became too crowded. And instead of looking for gold, you should have sold picks and shovels. You should have given people what they needed, not what they wanted. There's a lot of themes or gold rushes that we see in the marketplace today. There's AI, there's interest rates, there's renewable resources and energy, bank regulation, demographics, as John alluded to, which impacts healthcare. There's opportunities that we see today. Some of them are extremely crowded, and it makes sense to use the picks and shovels, and some of them it makes sense to invest directly. Last year, the predominant theme in the marketplace was technology names. The NASDAQ returned an astounding 45%. Now, as David mentioned, if you zoom back another year, they were down 33%. So really, they were just playing catch-up. It outperformed every sector in the universe, including a picks and shovels type industry like rail transportation. Now, if we zoom back even farther, though, it's interesting to note that rails have actually outperformed the NASDAQ. Why is that? Well, it became too crowded. You see, we've outperformed in various markets, including the Nicola Core Composite. As John alluded to, the Core Composite is an aggregation of realized client returns, and over the long term, we've also outperformed the NASDAQ. What happened years ago during the dot-com bust was that technology names suffered a minus 76% drawdown. It became too crowded. Our Nicola Core Composite was down just minus 11% peak to trough. In fact, technology names took over 15 years to recover their losses. There are other themes that we see in the marketplace today, including healthcare. There are fantastic drugs out there, but just because they're fantastic drugs doesn't mean they're fantastic investment opportunities. There are drugs that target amyloid plaque that help with dementia. There are drugs that target diabetes that help us also lose weight. There are PD-1 drugs that use our immune system to help us fight cancer. The thing is, these drugs oftentimes, and these drug companies, are very expensive. They're trading at a 300 to 400% premium to their peer group. What is the picks and shovels approach here? What is the common denominator? There's a stock we like, Becton Dickinson. Becton Dickinson is a leading manufacturer of syringes, and all of those drugs are biologics. They are large molecule drugs that require injections. Becton Dickinson is 6 times larger than its nearest competitor. It provides pre-filled syringes for 70 out of the top 100 biological drugs. And best yet, a syringe costs about 5 cents. 1 cent more than effectively a no-name brand competitor. No one is going to cheap out for 1 cent when it comes to a syringe. How about fixed income? As John alluded to, high yield is a bit expensive. High yield default rates have picked up to about 3.7%, while spreads have compressed to the mid-300s. We like investment-grade bonds. We like names like Microsoft, like McDonald's, like Amazon, like Royal Bank. And we're using prudent amounts of leverage to enhance returns. The position we're taking is that these companies, within 2 to 3 years, they are not going to go bankrupt. We are highly confident in that position. The public assets team has 19 members, with an average work experience in the investment management industry of 17 years. We've seen a lot of gold rushes, we've seen a lot of opportunities, we've seen a lot of themes, and we've approached them in an ability to take a look at how we maximize probability. None more so than the fixed income market. Over the past few years, we've seen 3 distinct environments. It was only a few years ago that we saw interest rates fall lower and lower. In fact, interest rates fell for 40 years, to the point globally, most countries had negative interest rates. We were able to outperform in that environment. And then COVID hit, an unprecedented event. No one anticipated that global economies would be shut down. No one anticipated that we'd be forced to stay in our homes. But we moved and we were trading in our homes, and we were able to pivot our portfolios to outperform during COVID. And finally, we've had inflation pick up drastically and interest rates pick up. We've been able to outperform in that environment too. Going back to our prospector, remember 100,000 people went to the Yukon. Only 3% of them, 3,000 people, found gold. Very poor odds. Our Nicola Core Composite, over the past 10 years, we've been profitable in 78% of months. Much better odds. We focus on the Nicola public assets specifically, and we compare it to our competitors. We've been able to utilize the picks and shovels approach when it's prudent. We've been able to reduce drawdowns, and because of that, we've been able to add significant value. We've been able to outperform our peers, public assets to public assets, by a significant margin. If you invested $2 million with us 10 years ago, today you would have had $1 million more, or about enough for a condo in Whistler. Pretty good result for any prospector. Thank you. I would like to introduce to the stage next my colleague Bijal Patel, Head of Private Capital.
Thank you, Ben, for that introduction. It's my pleasure to be here tonight to give you an update on private capital. Institutional investors have long known a secret. That secret is investing in private markets. Institutions invest well beyond just the public markets. If you look at Canadian pension plans in particular, over 50% of their allocation is to the private markets. High net worth individuals, meanwhile, down as low as 2%. So why is it that these big, sophisticated pension plans, why do they invest this way so deeply into private markets? I'll give you 3 reasons. Number 1, the ability to earn enhanced returns. Over a 15-year average, over 200 basis points higher in private markets than in public markets. Number 2, reduced volatility. We all love a really good roller coaster, but not when we're investing. Less price fluctuations in the private markets. And number 3, more opportunities. There are 7 times more private companies out there in the marketplace than there are public companies. So think about that. If you want great diversification, if you want access to some of the best companies out there, you need to think about allocating your money into private markets. So why is it that individual investors don't allocate the same way as pension companies? Well, it's complicated, it's hard to navigate, and to be honest, access has been made really difficult. So our goal is to unlock these markets for you. And when I think about the traditional barriers, I think of it this way, as the 3 10s. You often need $10 million to invest, you don't get your money back for 10 years, and you get as few as 10 companies inside your portfolio. At Nicola Wealth, with our open-ended evergreen pools, you don't have to worry about minimum deposits, you get ongoing liquidity, and you get great diversification from day one, dollar one. We're also able to access a lot of these investments at lower cost than an individual may be able to access them at. And so why is that? We have scale now. We are one of the larger providers of private capital in Canada. We have over $3.5 billion in assets spread across all the key asset categories. We have a amazing team of 24 individuals who run around the world looking for new investments for our clients, supported by an external investment committee, and they don't like this when I say this, with 150 years of experience. And so now let's turn to some of the trends that are impacting private capital and, to be honest, impacting capital markets around the world. Rise of inflation and the impact on rates. We're currently going through a process now where we've seen 11 hikes over 21 months, resulting in over 500 basis point increase in rates. And I still say it, even though John stopped now, still think there's higher for longer potentially, where you're going to see elevated rates for an extended period of time. So what impact has this had on private capital? Well, let's start with private debt and mortgages. It's actually been amazing for them. They've had some of the best performance and demand that they've ever seen. I pulled this chart from Google Trends, which shows the search history on the term private credit. In the past 18 months, a 100% increase in people wanting to understand more about private credit. Demand is surging. And the reason for this is we are now in an environment that people are calling the golden age of private credit. In my 30 years of working in finance, I've never seen an environment where you can earn 12% in private debt, that's secured, 8% in secured mortgages, with competition going down as banks have pulled away, and credit environment stable. It's the golden age of private credit where you can earn equity-like returns without taking equity-like risk. Now turning to private equity, yes, performance has been softer here. Higher rates have impacted the asset class, it's frozen out M&A activity. harder to finance transactions. The good news is that all M&A dry spells end. They usually don't go on past 18 months, and we're in month 15 or 16 of this current one. And we think it's going to end sooner than later because financing costs have peaked and should start to come down. And private equity firms are sitting on a record amount of cash, over $1.4 trillion. $1.4 trillion ready to invest into new companies. It's 3 times the size of the federal government spending every year. And once that happens, once that $1.4 trillion starts to get deployed into M&A activity again, you'll start to see exits happen, and you'll start to see valuation gains. On average, when a company is sold, it's sold for 40% greater than the carrying value of that company. So as these exits happen and the valuation pops start to happen again, you'll start to see returns normalize to the long-term average for private equity. Infrastructure now. This is an interesting asset class that doesn't feel the same pressures from higher rates and inflation. It's got cushioning in there through 3 ways. It's got contracts that allow you to reset prices if costs go up. It offers services that are essential, so think about water, transportation, energy. Even if costs go up a bit, demand stays about the same. And they're hard to enter markets, so you don't worry about new competitors coming in and disrupting the marketplace. What is going to change is the massive amount of debt that the governments all around the world have. So who's going to pay for infrastructure now is going to be private sector dependent. So as the world moves to more clean energy, as we go out and rebuild our transportation systems, as we digitize the world, the private sector infrastructure component of that is going to become increasingly large. And so demand is going to continue to grow over the next 10 to 15 years as governments can't afford to pay for this, and they're going to look to the private sector to fund all of this. So I have 2 daughters, and they always ask me the same question. Dad, what is it that you do at work every day? And I tell them I put on these nice designer running shoes that they buy me for Father's Day. And then I run around North America with my team, and we look for the next best investment for our clients and our advisors. So I wanted to highlight one that we participated in a few years ago. It's a car wash platform in the Northeast US. So it was a private equity investment, so it's about value creation. So you go in and you buy a company, you add value to it, and then you sell it for a multiple of what you purchased it at. So how are we adding value to this company right now? It's 3 ways, really. First way is capital to scale the business. So growing out the footprint from 12 locations up to 60 locations. Number 2, profit improvements. So they have this interesting profit model where you can take a subscription-like approach to it, and you pay a monthly fee, and then you get unlimited car washes. So for everyone out there who has Netflix, it's a similar concept. Super easy to subscribe, super hard to turn it off. So this improved profit margins. And then number 3, multiple arbitrage. So when you go and you buy single stores or new locations, you can try to buy it for 4 to 5 times earnings. And then eventually when we sell this entire enterprise, because of the scale, the improvements in profit, we can now sell it for 8, 9, 10 times earnings. So you buy low and you sell high. We underwrote this to a 29% annual rate of return. So in closing, if these are the types of investments that are interesting to you, then you always have to think about how much money are you allocating over to private markets. And with that, I'd like to now turn it over to Mark Hanna, who will give you an update on real estate.
Hello, everyone. Thank you, Bijal. My name is Mark Hanna, and I am the Managing Director for Nicola Wealth Real Estate. John, even you didn't get that. So as David sung, that was my team clapping in the background. They affectionately call me the Chief Disruption Officer, but no, it's really Managing Director. As David Sung mentioned, the firm is celebrating their 30th anniversary this year. The Nicola Wealth Real Estate team also hit a milestone. It's our 20th anniversary. And I go back to 2003 when a mutual friend introduced me to John Nicola. And I'm sure in that meeting, John thought I was crazy. I thought he was crazy, but once we got over that, we learned that we had a shared vision of buying real estate assets for Nicola Wealth clients. We've come a long way, John. And fast forward, we now have 3 open-ended evergreen funds. The first fund was established in 2005. And it's made up primarily of industrial and multifamily and self-storage, with smaller exposure to office and retail and seniors. The return since inception is 9.4%. In 2023, the return was 2.1%, and there's no question that interest rates had an impact on returns for private real estate funds, and we're probably one of the very few funds that was in the positive territory, as most were negative. The second fund was our U.S. Income Fund. This was established in 2010, and this has got a heavy concentration in multifamily in the U.S., over 50%, with a balance in industrial and IOS, which I call industrial outside storage sites. The return last year was 1.6%, also impacted by interest rates. And the return since inception is 11%. The last fund is the value add fund. And this works on both sides of the borders. And it includes build to sell, repurpose, and it involves multifamily, industrial, and it also involves working with many partners. The return last year was 5.3%, and the return since inception was 13.5%. Overall, we have 340 properties, 20 million feet, and 10 billion in gross asset value. So it's grown quite a bit in that 20-year time frame. Okay, so fund composition. A lot of you have heard me say before that fund composition matters, and not all funds are created equally. And as John pointed out, I hate office, and he's right, I do hate office. It's very capital intensive. So we spend a lot of time focusing on the asset types that we want to be invested in so they can survive in a stressed environment. And those include multifamily, industrial, and self-storage. We do have some exposure to retail and seniors and office. But this has contributed to 95% occupancy and great income growth. The other contributing factor is the geographic markets that we select. So in Canada, we're in most major markets with a heavy concentration in Vancouver and Toronto. Yes, those markets are expensive, but they have great liquidity and they're worth it. The US, a little bit more diversified. That's primarily due to our larger multifamily portfolio. What a great picture. We have 65 people on our team. Obviously, they're not all on this page. Just like my colleagues, people matter. And we have great diversity on our team: asset management, development, finance, debt, acquisitions. Our team is very passionate. They're in the office every day, and it's intense, and they want to work hard to get wins for our clients. And this is definitely a key ingredient to our success. Okay, so what sets Nicola Wealth Real Estate apart from the marketplace? Well, I've talked to you about our track record, our fund composition, and the importance of our team. That allows us to execute on our debt strategy and our asset management strategy. And that leads to how do we create value for our clients? And that's what I'm going to talk about today. So I've got 6 examples. The first is Royalty Row in Texas. And at first glance, you might look at this property and say, wow, that's ready for the scrapyard. But not so fast. Our team, along with our partner in the US, thought we could make a difference. And they implemented building efficiencies and aesthetics and made this a great financial success. The second example is in 25 Watt Line in Mississauga, in Toronto. And we bought this property about 7 years ago, and the building was built in the early 1990s. So the building is structurally sound, but the building systems are obsolete. So our team got in there, improved on these efficiencies for the building. And so, for example, they put in building controls and new systems, which saved enough to generate 7 homes annually. We improved the water efficiency so that we could save the equivalent of 4 Olympic-sized swimming pools per year. Just think about it. Just that building saves that much water. In addition to that, we added our value-add strategy to improve the revenue for this asset. The third example is multifamily, and we do like multifamily. This is in Victoria. This is a 275-unit apartment building. One thing we like about multifamily is that we can get very attractive CMHC financing. This building is in downtown, and it is now under construction, and will be ready for the first tenants in Q1 of 2026. The fourth example is self-storage. And I love self-storage, and I've often said that people will pay $500 a month to store $300 of treasure. Sometimes they say junk. This is in Maple Ridge, this asset, and it's the fourth and final phase. We're very proud with this building. It'll be the first net zero carbon self-storage building in Canada. The building is now under construction and will be ready for the first tenants in this summer of 2024. The next example is industrial. And we like industrial, and we have a lot of it in both Canada and the US. This property is 601 Milner, and it's in Scarborough, a suburb of Toronto. It sits on the 401 highway, which provides excellent exposure for tenants and easy access. It's got 40-foot ceiling heights, so it's very attractive for high distribution users. This building will comprise 350,000 square feet, and it's now under construction. It'll be ready for the first tenants this summer of 2024, and we already have a lot of strong interest from users. The last example is a good example on how our team can pivot when the unexpected happens. And this is 226 Wycroft. This is in Oakville, also in Toronto. We bought this property approximately 7 years ago, and at the time we negotiated. It has Tim Hortons in the front, but in the back it had the old Tim Hortons executive offices, which were empty. But we negotiated a long-term lease with a tech-related company to de-risk the asset. Then COVID happened, and then after COVID, none of their staff came back to the office. So the company deemed this as redundant space, so they approached us, and we negotiated a very attractive lease surrender on favorable terms, which allowed us to redeploy those funds to reposition this property back to an industrial property, which is what the original use was. This work is now underway, and it'll be ready for occupancy in the summer of 2024. And finally, let me close with this. Where's the opportunity? There's no question that many buyers are on the sidelines right now, and it'll probably be that way for another 6 to 12 months. And with that, sellers' expectations have definitely been moderated over the past 6 months and will continue to do so. The Bank of Canada and the US Fed, after 10 successive interest rate hikes, have finally stopped increasing rates. And there's even the prospect that interest rates will come down, probably Q3, Q4, which everybody will be happy to have, including the real estate industry. And what that means is that we're probably at or the bottom of the cycle, and it creates an incredible buying opportunity that allows us to acquire assets well below replacement costs that are accretive to our funds. And I'll finish with this. As most people know from Vancouver here, they probably recognize the name Joe Siegel. And he unfortunately passed away a couple of years ago, but I had the opportunity to work very closely with Joe over the years. And he had a great real estate mind, and I learned a lot from him. And he would often say to me, "You make your money in real estate when you're buying, not when you're selling."